Hey everyone, it's Ethan here again, and in this video, I want to chat about points and lender credits. They do play a significant role for you when you're shopping around for a mortgage as a potential home buyer. I want to make sure you understand what they are and what to look for in your loan estimates and when the right questions to ask your lender when you're in that process. So, the main point is that points and lender credits are tied to your interest rate. They will have a direct relationship on each other. And how strong or weak that relationship is will really depend on your lender, your loan program, or even market conditions. So always be sure to consult a mortgage professional when making these choices. Points make the trade-off between higher closing costs for a lower rate. So you can pay more upfront to have a lower monthly payment. And it's really good for those keeping the loan for a long period of time, at least longer than the break-even point, which we'll calculate in an example in a second. But you want to make sure your upfront investment into buying points is paid off in the long run. So 1 point is going to represent 1% of the loan amount. So for example, if you have a $500,000 loan amount, 1 point on that will be $5,000. And keep in mind, it doesn't need to be a clean whole number like one. It could be 1.25, 0.75, 0.358, or 1.7, whatever. The point is, there will be a percent of your loan amount. So a lender credit will be the exact opposite of points, right? You will be able to get a credit on your closing costs, so you will bring those down in exchange for a higher interest rate. So this will make more sense for those borrowers that are looking to keep more money in the bank and keep their savings in there, but they can afford a higher monthly payment. And that's an option that people will consider. I'll show you an example of that as well. And it is calculated the same way as points, so it's still 1 point as a percentage of the loan amount. It would probably be shown really as a negative point there. So negative 1 point on $500,000 is a $5,000 credit. Then I'm going to show you this example. So we have an analysis here. A hypothetical analysis, of course, these rates are just to show you what the effects of certain points might have. So in this case, I'm going to look at 1.25 points and negative 1.25 points compared to what a 0 point situation would look like. So if we look in the middle here, $1 million purchase price, 10% down, $900,000 loan amount. At that, we're looking at a rate of 6.49% for a total payment of $7,045. So at this loan structure, we have a cash to close of basically $120,000. That's no points. And if you're comfortable with that payment, great. That's what we'll go with. But let's say you want a lower payment and you don't want to pay $7,000 per month, but a payment like $6,700 is a little more suitable. You would need a rate of 5.875. And to get that rate, you would need to pay about 1.25 points, which if we look at the difference here, it ends up being about $11,000. I can actually show that specific cost right there in there. And so it's $11,250 because it's 1.25 of that $900,000 loan amount. So that's an option where you would lower your payments and pay more upfront. And then on this particular situation, you would want to calculate your break-even period. So how many months do you need to hold this mortgage to break even on that initial $11,000 of points? So what I would do is if I'm paying 1.25, that's 11,250, 11,250, and I would divide that by my monthly savings. So I know how many months it takes me to recuperate that investment. And so I'm saving about $359 per month. I'm just doing it on my calculator, and you get about 31.33. Hopefully you can see that well. 31.33. So you know that you need to hold on to this mortgage, not refinance or sell the house, for about 31 and a third months before you break even on that investment. After that point, then you're saving on a monthly basis. So let's say you want to go the other way. Maybe you don't have $130,000 or $120,000, but you have $110,000 or so. That's what you want to spend on your mortgage. That's your budget. That's what you decided you can shell out. So looking at the same purchase price and loan amount, we would be able to give you a lender credit of negative 1.25 points, which is $11,250 on this loan amount. And you would have a higher payment of $7,425. So maybe you don't have as much money saved up, but you want this house and you're okay with having a payment that's another $380 higher than what it would be at 0 points. So there's really a lot of flexibility and a range of options for what you can do when playing around with buying down your rate and having a lower payment, or lower your closing costs and having a higher payment. It really is going to depend on your own financial situation. So it's important that you consult a mortgage professional to help you walk through those options. So please, of course, always ask any questions, comment, share, and like the video. And here's another interesting graph that we can look at too. Interest and mortgage insurance paid over 15 years. You'll actually show that you pay less in interest with lower interest rates. So you can track stuff like that. But again, please share this with any friends, family, or any potential home buyers out there that may not understand this topic as much. And of course, if you have any questions, please reach out. Thank you and have a great one.